Welcome to video series on business of trading. My name is Vitaly Pinkovsky, founder of marketprofessor.com. And today in our program, how long does it take to turn 20,000 into 2 million trading financial markets? A realistic view on opportunities of active short-term trading. We as traders gotta have a reason to wake up every morning, turn on our computers and expose ourselves to all kinds of risks and surprises. Perhaps take some beating, maybe a few punches in our face. And we do so day after day, month after month, and if we survive, year after year. Having losses is part of our job description, and losses mean only one thing: pain and lots of pain. So what keeps us going? Only one idea: our dreams should be bigger than our pains. We've got to have a vision to enhance our lives, and clear understanding of our goals and profit expectation can provide the motivation necessary to get into the game every day. In Michael Jordan words, you have to expect things of yourself before you can do them. What you're about to hear has nothing to do with a get rich quick. It also has nothing to do with get rich slow of traditional investment philosophy either. You won't hear such nonsense as if you invest 2,000 in stock market at the age of 18, you'll die a millionaire at the age of 100. Instead, we present a realistic look at the potential of short-term trading. Our approach is based on bottoms-up empiricism, not on financial advisory propaganda or on theories of the so-called academics who never traded themselves. In fact, many different scenarios and calculations presented in this video would defy conventional thinking and definitely challenge traditional views on the rate of return. Now, bottoms-up empirical approach means that we just observe the data and make the assumption about what the real process might be, and calibrate by adjusting our equation in accordance with additional information. As events present themselves to us, we compare what we see to what we expected to see. Again, it's a bottoms-up, theory-free, evidence-based approach. Trading is, first of all, a business. And it's only natural for any trader as entrepreneur to find out about money-making opportunities in trading. In other words, traders should ask, can the market pay me? In our calculations, we'll assume that a trader chooses S&P E-mini futures markets as a trading vehicle, which I think it's the most efficient one, and allocates 10,000 for each unit of risk, or contract in futures lingo. Okay, let's take a look at the chart of S&P E-mini futures, and it's, by the way, it's January 10th, 2008. Each bar here represent 5-minute periods. The whole day is a decent average volatile day for S&P futures with a 30 points swing from low to high, from here to here. By the way, the average price movement of the S&P 500 E-mini futures market in the last 5 years, probably around 15-20 points, and each point is worth $50 per contract. So, for example, if I buy, let's say buy here and sell here for 1 point move, I'll make $50. Or let's say I buy here on the top and sell here, then I lose $50. Now let's assume that trader has $20,000 in capital and buys 2 S&P futures contracts. So in this case, 1 point for this trader would mean either $100 win or loss. So let's say you buy 2 contracts in the morning at 9:30 right here, and then you sell it. This is a 5:30. You sell it for the 30 point. This is a 30 point profit. That means you've just made $3,000 and you have 15% return on your investment. It's only in 1 day. Now, would you like me to teach you how to catch these big moves? I'm sorry, I can't. And actually, nobody can. And if they claim they can, they're lying. It's simply unrealistic to catch such a big moves on a consistent basis. Remember, trading is not obvious. Great trading ideas become obvious only at the right edge of the chart. We are all geniuses when we have the power of the hindsight. But the beauty of playing the financial markets is that there is no need to go for the big kill. You can make a very, very good living averaging just a few points a day. So the basic premise here of our approach is to build profits block by block and make it a goal to lock in small gains every day. Think about it. What if you could catch on average 2 points a day, which represent a small fraction of daily market fluctuations? For example, let's say you make 3 trades a day. Okay, this is 9:30 in the morning, so you buy one contract in the morning, right? Then you sell it here for 2 points profit. So yeah, this is 1405 and this level is 1410. So this is a 5-point move right here. So let's say you just catch this small move here. So you are up 2 points. And then you decide to make another trade. So you buy another contract right here. And the trade does not go in your direction, so it goes somewhere here. So you decide, okay, I'm going to take my loss. This will be your losing trade, -2. Now you wait patiently and you see this big strong candle and you decide, oh, maybe the market turn around and there's a strong uptrend potential. So you decide, let's say, to buy here and sell here. So this is another 2-point win. Okay. Just this portion represents another 2 points. So you're up 2 points. And then you can say, okay, I'm done for the day. So this is your results for the day. You have 1 win, you have 1 loss, and you have another win. So total +2 for the day. Or you might have two losses in a row, small losses, and then another relatively big win +4 points. But the idea is you want to be a winner at the end of the day, with 2 points. Remember, trading is a numbers game. And the trader is like a mouse trying to catch a bite of a cheese from the trap. And the mouse has to be quick to get what she wants, and the trader got to be quick and agile as well. The amazing thing about the trading is that producing 2 points on average per day on a consistent basis creates a fortune in a relatively short period of time. And if this sounds too hard to believe, let's do the math. All right, let's consider this scenario, which should give you a good framework around which to calculate your expectations. So the goal is to produce 2 points a day, and we're going to allocate $10,000 of capital per one contract. We increase the number of contracts traded as our capital size grows during the year, and we never risk more than 2% of the capital per trade. So again, we start with the 20,000. Then at the end of the first month, our capital will grow to 24,000. And at the end of the year, we'll have $178,000. And then, as you can see here, with as our capital grows here, also the number of contracts grows proportionally. Let's say at the end of the year, let's say if we made 178,000, then we can trade about 18 contracts here. Market. At the end of the second year, you're sitting in a nice profit of 1.5 million, and at the end of a fifth year, you're sitting in a nice profit of 1.5 billion dollars. Let me repeat for the peasants: 1.5 billion. Now, this all looks good and makes logical sense because scalability is a wonderful thing, but try not to hold your breath, because there's a little problem with this scenario one, because it's very difficult psychologically to increase the number of contracts as your capital grows. And the possible solution could be increase size only at the beginning of the year and keep the number of contracts constant throughout the year. And we're going to see how this idea works in our scenario 2 in part 2.